Have you ever wondered how value investing can help you in your investment journey? Well, you've come to the right place. Value investing is a strategy where investors actively seek out stocks that appear undervalued by some form of fundamental analysis. In other words, you're hunting for bargains, for stocks that are trading for less than their intrinsic value. The concept of value investing was developed in the mid-20th century by Benjamin Graham and David Dodd, and it has since been popularized by other famed investors like Warren Buffett. These investors have made a fortune by buying stocks when they were undervalued and holding onto them until their market price reflected their true value. Imagine walking into a store and finding a designer item on sale for a fraction of the price. That's essentially what value investing is all about, finding quality at a discount. Now that we know what value investing is, let's delve into how it works. So how does value investing work exactly? Well, it's a strategy that involves three key principles: the concept of intrinsic value, the margin of safety, and a long-term approach. Let's start with the idea of intrinsic value. This is the actual true value of a company, regardless of its current market price. It's like looking at a house, not based on its price tag, but by considering factors like location, size, and condition. In the same way, value investors look at a company's fundamentals, like its earnings, dividends, and assets, to determine its intrinsic value. If the market price is less than this intrinsic value, the stock could be a good buy. Next, we have the margin of safety. This principle is all about minimizing risk. It's the difference between a stock's intrinsic value and its market price. The larger the margin, the greater the safety net. It's like buying that house we mentioned earlier at a discount. If you can get it for a price significantly lower than its actual worth, you've got a good deal. Finally, value investing is a long-term game. It's not about quick profits or short-term gains. It's about buying stocks at a discount and holding on to them until their market price reflects their true value. It's the financial equivalent of planting a seed and patiently waiting for it to grow into a tree. Now, using these principles, value investors identify and buy stocks that are selling for less than their intrinsic value. They don't get swayed by market trends or short-term fluctuations. Instead, they focus on the company's fundamentals and buy when they believe the stock is undervalued. Understanding these principles is one thing, but applying them in the real world can be quite another. So, how can you make value investing work for you? Well, stay tuned, because we're about to dive into that in our next segment. There are both benefits and risks associated with value investing. One of the main benefits is the potential for high returns. By investing in companies that are undervalued by the market, you're essentially buying stocks at a discount. Over time, as the market corrects itself and the true value of these companies is recognized, you can expect to reap substantial profits. Value investing is also considered less risky than other strategies, as it's based on solid financial indicators and not market speculation. But remember, less risky doesn't mean risk-free. Now, let's talk about the risks. The most significant one is that the market may not recognize the intrinsic value of the stock within your anticipated time frame. You might have to wait longer than expected for the market to correct itself, which can tie up your capital and potentially limit your ability to make other investments. While value investing can be a powerful strategy, it's not for everyone. So is it right for you? Only you can decide if value investing is right for you. But just to give you a little more clarity, let's delve into the characteristics that may make it a good fit for you. A key trait of successful value investors is patience. This strategy often requires a wait-and-watch approach, as the true value of a stock may take time to reveal itself. Another aspect is the willingness to go against the crowd. Value investors often buy stocks when others are selling and sell when others are buying. Moreover, the ability to analyze financial statements is crucial. This helps in identifying undervalued stocks and making informed decisions. Conversely, if you're someone seeking quick returns or if deep diving into financial analysis doesn't really excite you, value investing might not be your cup of tea. Regardless of whether value investing is right for you, understanding it can make you a more informed investor. That's it for our guide on value investing. We hope this video has given you a clear understanding of what value investing entails and possibly sparked an interest in exploring this investment strategy further. If you found this video helpful, please hit the like button and share it with your friends and family who might also benefit from this information. And don't forget to subscribe to our channel for more investing tips and strategies. We're dedicated to helping you make informed investment decisions. Thank you for watching, and here's to your journey towards becoming a better investor. Happy investing!